One of the defining features of many bonds is its coupon, a fixed rate of interest that is generally paid semi-annually to the investor until maturity. Zero coupon bonds, however, are the exception. Zero coupon bonds are issued by a variety of entities. The U.S. Treasury, publicly traded companies, and city and county governments are among them. They also tend to have longer maturities of 10 years, 15 years, or greater. But instead of offering regular interest payments, zero coupon bonds, or zeros, are purchased for a discount that is lower than the typical par value of $1,000. Yet the full value of $1,000 is still returned upon maturity, barring any default by the issuer. Therefore, the return the investors receive is equal to the difference between par, say $1,000, and the discounted price for which the bond was purchased. This amount is referred to as the accreted interest. While investors who purchase zeros do not receive regular interest payments, they may still pay income tax on the accretion amount. If you purchase a zero coupon bond with a 10-year maturity for $500, you will earn $500 in accreted interest. This amount is then spread over the number of years until maturity, so each year you will be required to pay income tax on $50, even though you will not effectively receive the money until maturity. The cost basis, or the bond's price used to assess capital gains or losses, is also adjusted annually to account for the accretion. So after 1 year, the price of the bond will increase by $50, making the new cost basis $550, and so on until maturity, at which point the cost basis will be equal to $1,000, meaning no capital gains will be realized. This feature can be an attractive option for investors planning for a future expense or financial goal, like education costs or retirement, where regular interest payments over the life of the bond are not dependent upon. However, if you decide to sell the bond prior to maturity, you have the potential to experience a capital gain or a capital loss, depending on how the market environment compares to the bond's accreted value. Despite the fact that zeros do not experience the same reinvestment risk as bonds that make regular interest payments, they are not immune to interest rate or market fluctuations. In fact, because they offer the entire payment at maturity, zero coupon bonds can actually be more volatile than other bonds, with their prices taking a comparatively larger hit when interest rates rise. At the same time, in the event that interest rates fall, the value of zero coupon bonds may increase in value more quickly than their interest-paying counterparts. Due to their typically longer maturities, inflation risk is another thing to consider. The money that you receive upon maturity of your zero coupon bond could be worth less compared to today's value, depending on how inflation affects the US dollar. To continue building your investment knowledge, subscribe to the Zions Direct YouTube channel.